Welcome back to Real Estate Radio. I'm your host, Ryan Sloper, joined by Louis Cammarosano, the general manager of HomeGain. Quick reminder, Real Estate Radio is designed to build the Washington, D.C. Metro's real estate markets by giving you good free advice. If you ever have any questions or concerns regarding your credit, your real estate, finance, anything, feel free to reach out to us at our off-air number. That's 877-245-2030. That's 877-245-2030. So we're going to jump in and kind of discuss with you guys how you can buy 77% more of a home today than you could 10 years ago. And I think that this is it's one of the most astounding things that I've came across in a while. But comparatively speaking, since in 1991 is the last time that the purchasing power was equivalent with low rates. But I'm looking here that if you in 1991 had a loan size of $200,000, your mortgage payment would be roughly $1,700. Now, in 2011, as of today, you could have a mortgage payment on a loan size of $353,000 and have that same $1,700 mortgage payment. Now, what that really boils down to is that, buying a home in today's market is a relative bargain compared to what it was 10 years ago, and I really don't think that we're going to get much lower as far as the cost of home ownership. What that is your monthly budget of how much you're willing to pay for your principal and interest, your taxes, insurance, everything in there. It's just, the rates are scraping rock bottom lows in 2011 at levels that were previously unthinkable to economists and everyone, including Louis and I, who have said that we thought that rates didn't have any place to go but up. For you that's out there that's thinking that you're going to get a better deal by waiting another 6 months to a year, I really just can't see it happening. I mean, for those people out there that are considering refinancing, which a lot of that's been going on, if you're not upside down on your house, meaning that you owe more on your house than your house is actually worth, there's a ton of that going on. And I know in some loans with $400,000 or $500,000 loans, saving even 0.25% on an interest rate would be a lot. But for a lot of you out there that, are stuck in 6% loans and not able to do anything. I mean, imagine if you were able to refinance at 4%. I discussed last week that I thought one of the smartest things that the government could do is step in and start kind of forcing the hand of a lot of these banks and Fannie Mae and Freddie Mac to refinance people that are upside down and don't take any consideration with appraisals and whatnot. Now, that's probably not going to be the case. But so for those of you out there that don't currently have loans, that don't own a home now, and you're maybe a first-time home buyer or somebody that's sold a home and has just been renting over the last couple of years, these things makes a lot of sense right now today to be able to really go out and buy more of a home than you could buy 10 years ago, a nicer home in a better community at about the same price as what you would, actually it's a much higher price than what you would pay 10 years ago. I mean, don't you think that's pretty staggering, Louis? I mean, it's $153,000 difference from 1991 to 2011.
It is a big difference, and the argument for that is not home prices, but cost of living will probably go up in the next 5 to 10 years, including your cost of shelter, which may be rent. Whereas if you can purchase your home now at a very long-term low interest rate, your living expense will remain constant and low as the cost of living rises, even if your home price declines a bit in value.
Yeah, I mean, absolutely. I mean,
and right now, I believe it makes sense in the D.C. metro area. The rent-to-buy ratio is more favorable to buying.
Absolutely. I mean,
that spread will widen as your mortgage payment remains constant and rents continue to rise.
And we've been seeing, basically the rents have been going through the roof lately, and I think that trend's only going to continue down the road. To be able to lock yourself in today at rates around 4% range, obviously depending upon your qualifications, guys, always remember to check APR when you're shopping for a mortgage. You want to make sure that you're getting quoted something accurate. Annual percentage rate is the best way to do so. But, just for instance, I had a client the other day that was, he's like, he owns one property now. He doesn't owe very much on it. And he was thinking about, just either refinancing his first to go and purchase another property, either for an investment purpose, or he was thinking about potentially moving into it. He just wasn't sure. And I said, well, either way you have it, I mean, you're obviously going to get a better interest rate if you buy it as your primary residence, but you still can lock in an investment rate basically somewhere in the high 4% range on an investment property. Since he doesn't know very much on the other home, he more than qualifies. I just said it's really a no-brainer if you're looking to, add real estate into your portfolio for your retirement or whatever it may be. I said you're just not going to be able to touch these rates. Now, I'm not saying next year because they could be around for another year or two. We just don't know. But long term, they don't have any place to go but up, really. So, we sat down and worked the numbers every which way. And, if he decided to, take and put a 20 to 30% down payment on that property, he could somewhere net positive cash flow of something about $500 or $600 a month, which is a great return. A great return. And if he just chose to move into it as his primary residence, he could turn around and rent the other one out that he's currently living in now, and he would have a net positive on that one of somewhere around $800 to $1,500 a month, just depending
You
upon.
probably refinance that loan as well.
Exactly. And that's the win-win situation. And that's what a lot of people now, I know a lot of the questions I get from people that are calling in at the off-air line, it's 877-245-2030, is, well, Ryan, we are we're upside down. We can't do anything. And I completely understand that. And that's where I said last week when I was discussing the same thing, I said, sometimes the best thing is to come and talk to a professional that can analyze your situation and try to come up with some solutions. The solutions may not always be what you want to hear, but at least you can know your options. I've had some people that have just decided to move out of their property and go and rent somewhere for a year so that they could actually start counting that rental income that was coming in, so they could qualify for a home a year from now, because it has to be documented on your tax returns for at least a year. So I'm thinking that, even if, and that was probably about 6 months ago, Lewis, that happened from that one particular client. 6 months from now, he'll be able to document a year's worth on his tax returns. He can purchase that property, and rates are still going to be relatively low. Now, is that going to hold true for everybody? Probably not. I will tell you that even if interest rates go from 4 to 5.5%, that's a great rate. Historically, these are extremely low rates, and even if it were to go up to 5%, it's still a great rate. And with rental prices trending upward, I don't see that stopping anytime soon. Even if you go into the 5%, it's probably going to make sense for most of you to consider buying. There are so many first-time homebuyer programs out there, especially in Virginia, that require zero down payment. Now, there's obviously income restrictions that is going to make you qualify or not qualify. I have seen those income limits going up, though, and not down. So, like for a VHDA loan, you can actually couple an FHA government loan, which requires a 3.5% down payment, and you can get that 3.5% down payment subsidized. Basically, it's forgivable as long as you stay in the house for 10 years by the Virginia Housing Development Authority for 3.5%. So basically, you don't owe anything as long as you stay in it for a 10-year period. If you move out before then it's just a prorated amount that gets paid back to them. But that's basically borrowing. You're getting free money, essentially. I mean, you're borrowing, and their interest rates that are on these loans are at market rate, if not below market rate. I was seeing if you wanted to pay, one discount point, you could get down somewhere around 3.75%, which is incredible. And that loan, the income restrictions are up to almost $120-some thousand a year for the household income. I know a lot of people that fall into that category. That's one particular loan. There's another one that actually they classify a first-time home buyer as you just can't own another property at the time that you're trying to qualify for the new one as a first-time home buyer. So as long as you've sold your property and you're trying to buy another one, they'll still classify you technically as a first-time home buyer, which is incredible to me, Lewis. Don't you agree?
That is that's pretty good.
It's pretty good. I mean, because a lot of the times they say you can't have owned a home in the last 3 years. They have some sort of waiting period. But this one, as long as you sell your house, you're qualified for it. This particular loan, I believe it's called the CHIP loan. You can basically get 100% financing with no mortgage insurance. Once again, there's income restrictions, but these programs are out there, and for a lot of you people that are considering buying, I highly suggest you reaching out to me. I can give you the info on these loans because, it might take somebody that's on the fence not thinking they're going to qualify because the mortgage insurance on an FHA loan is 1.15% monthly. Well, there's programs out there that don't have that mortgage insurance. When you drop that $200 a month, you might well qualify for a loan.
What's astounding about this, Ryan, is that I didn't know about this, and what most people do is they tend to listen to the national media or their social media. And social media is generally a good way of getting information, except not for things like real estate, because these are kind of, I wouldn't say they're esoteric, but you really need to talk to a professional, someone who's in the market every day, who knows what's going on in the market with respect to mortgages or real estate prices and so on. Your social media friends, unless they're all mortgage brokers, generally don't know this stuff.
Yep.
And it really makes sense to reach out to a professional. And you also see it in the home gain survey, the FSBO versus Realtor, that when you try to sell your house on your own, you have a 50% less chance of getting it sold. So social media and just doing it yourself works for a lot of things, like getting restaurant recommendations and so on, but it doesn't really work when you're going to buy or sell a home. You really need to reach out to a professional who's involved on a daily basis, because generally your friends don't know this type of stuff.
Absolutely. And I always say, you need to work with somebody that has their pulse on the market at all times. If you can't ask somebody, what's going on today that could affect interest rates, if they can't answer that question, then you're probably working with the wrong person.
They can answer the question. They won't answer it correctly.
That's you're right.
It won't stop them from answering the question, and that's the problem. And we mentioned this last week, is that people read about the economy, and you and I discussed that it's really what's more important is what your economy is, not what the general economy is, and whether you can afford that house. And a lot of it is dependent upon what your mortgage broker can tell you about whether you can afford that house based on the types of loans that are available.
Yeah, and I guarantee that your economy out there is better than you think. When we come back, I'm going to tell you how to improve your credit card rating and pay off your credit cards in 6 to 10 years just by following a quick few easy steps. Be right back.